Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures sinking this morning as President Trump reignites trade fears on Wall Street. The president threatening a 50% tariff on the European Union as he says trade negotiations are heading nowhere. The president also targeting Apple with a 25% tariff, of at least 25% if it does not manufacture its phones in the United States.
Plus, retailers taking a hit this morning as Deckers, the parent company of Uggs and Hoka, plunges after declining to provide full-year guidance amid macro uncertainty here. Meanwhile, Ross stores sinking after the retailer's second quarter EPS missed estimates. The company also withdrew its full-year sales and earnings guidance, citing heightened macroeconomic and geopolitical uncertainty.
And investors gearing up for the final Mag 7 stock to report earnings. Nvidia results due out next week with all eyes on the chip giant. The company is expected to deliver another strong quarter, but investors will focus on commentary regarding sales to China, the macro and tariff backdrop, and any visibility into the second of the year. Yahoo Finance will bring you full coverage of Nvidia ahead of those results. U.S. stocks sinking this morning as President Trump threatens 50% tariffs on the European Union, jolting stocks in what was shaping up to be a quiet trading day. The president also threatening Apple with tariffs, reigniting investor fears over the trade war, which last month sent stocks into a bear market. Joining us now, Joe Hegener, Asterozoa Capital CIO. Joe, thank you so much for being here with us this morning. Is this a reality check for a market that had somewhat forgotten the fact that we had not had any trade negotiations or deals yet with any of these countries?
I think that's absolutely right. Yeah, thanks for having me. Especially in the last few weeks, just given all of the crazy headlines that have come out and moved the market in such dramatic ways, up, down, left, right. I feel like there's been a lot of short-termism and kind of embedded within market volatility. The only thing we really got, as a relief to, that April 2nd independent, tariff implementation was a 90-day pause. And even then we knew that the best case scenario was a flat 10% tariff rate across all of the nations. And that was the best case scenario, assuming that every single country comes to the table and negotiates in good faith, which we're somewhat skeptical that actually takes place, given this administration is fairly aggressive in their posturing.
Joe, with all that in mind, is President Trump still seen by the business community as a pro-business president?
Oof. On the one hand, he's very pro-business in the sense that he wants lots of deregulation. He wants tax reform and tax cuts. He wants to cut all the red tape for the banking sector, and all of that is incredibly positive. But I think something that a lot of the Trump supporters from the business community didn't fully appreciate going into this administration was just the level of uncertainty we would get from a policy standpoint as it relates to tariffs and lots of other headlines. It's very, very difficult. If I'm the CFO of a business, I have no idea what the world's going to look like. I don't know what my input costs are going to be in 6 months from now. It's going to be incredibly difficult for that CFO to sign off on CapEx spend and R&D and research when we just don't know what the revenue profile, the expense profile of the business might look like. And that pullback from the uncertainty alone could create earnings recession.
So if CFOs and the C-suite of these companies don't know how to best forecast amid strategic chaos, as the White House and some of the cabinet members have talked about it, what are investors supposed to do?
Investors, in my opinion, are supposed to batten down the hatches. In terms of the normal distribution of potential outcomes, the left tail and the right tail. We kind of believe that the tails right now are incredibly fat or wide, meaning that it's very likely, with the historical lens or probabilistic lens, that we get a serious scream upwards in markets, but it's also very, very likely that we get a serious pullback, right? The days of kind of low and slow and the S&P 500 steadily going up by 25 basis points a day on average, we had about a 10-year period where that was the case. And, currently the sheer volume of volatility, or the amount of volatility embedded within markets, I think investors should embrace fixed income. A 4% risk-free yield is nothing to scoff at in this environment. And if you're willing to move up the stack a little or down the stack a little bit, you can lock in high single-digit returns, which are equity-like returns, and you're not taking the massive amounts of risk embedded within equity markets right now.
Yeah, and I wonder how much more risk premium needs to be baked into equities to be worth that risk in this environment. But having said that, we also have sources telling us that there's risks within the bond market. Obviously, Michael Hartnett this morning was saying to go longer in the yield curve here. But to what extent do you think investors are maybe worried about things like that 20-year auction and demand issues if they do go in on bonds?
That's a great point. See, it's somewhat nuanced within fixed income, right? Because there is definitely a risk where if this tax bill actually passes and we're adding $4 trillion to the deficit, if we get more deregulation, if Trump installs somebody who we know is going to cut rates next year, there's a serious chance that the long end of the yield curve goes substantially higher from here. And that's one of the reasons why at our firm, we actually have what's called a yield curve steepener on, where we're effectively betting on the front end of the curve to come down, but we're actually short the long bond to try to offset against that risk of yields going dramatically higher from here, and actually provides a nice hedge to the rest of our bond portfolio. But that's definitely a material risk, right? That long end of the curve, there's a tremendous amount of uncertainty, and we're starting to see investors get a little spooked, and what's going on in Japan and abroad is only exacerbating that risk.
And so as you're thinking about, for all of the kind of market sentiment that had really been looking at just anything positive to come, especially after the early onset of April's Liberation Day announcements and then the rebound thereafter, that was really just, okay, we're going to pause things. And as Maddie had pointed out when we were in the newsroom earlier today, we're halfway through that pause. So what are investors who are looking for the next major positive catalysts, or just hanging their hat on anything that seems favorable to come out, what are they going to look to next that seems like the next big driver here?
Oh boy. Personally, I'm bearish, just in all honesty. But I think if you're a bullish investor, I think what you're looking for are developments, positive progress in tariff negotiations. Hopefully this 50% slap on the EU is just a negotiating tactic and it gets resolved. You see tariff progress, and then you see the passage of a massive fiscal stimulus bill, right? That's an enormous amount of stimulus that's going to be injected in the economy if that passes and gets through. Not to mention the other leg of the stool, deregulation. Just purely deregulation from a banking standpoint, if they adjust kind of the capital requirements for the banking system, that actually allows all the major banks to be net much larger buyers of U.S. Treasuries, which could also help pull yields down, which would be supportive of the economy.
Joe, thanks for taking the time this morning.
Thank you.
President Donald Trump refueling trade tensions, threatening to impose a 50% tariff on goods from the EU, as well as 25% tariffs on Apple's iPhones. The levies on the EU would take effect on June 1st. Trump saying in a post on Truth Social that talks are going nowhere. And joining us now, we've got Shai Akabas, who is the Director of Economic Policy at Bipartisan Policy Center. Good to have you here with us. Just take us into your read-in now on the latest on some of the trade policy and I guess strategic chaos, as it's been talked about by some of the administration members.
Yeah, well, thanks for having me. What we've seen in the tariff policy over the last several months has been really driving the uncertainty in the economy, and from a business standpoint, from a consumer standpoint. And it's very understandable that there are goals that we have with these tariffs, that we are trying to renegotiate trade deals that have been in place for many years, get more fair trading relationships. We understand the administration's goal is to bring back some of the manufacturing to the United States. Those can be accomplished in a variety of ways, but when we are seeing these fluctuations in tariff policy, it makes it impossible for small businesses especially to plan how they're going to conduct their business. It makes it very difficult for consumers who hear that inflation might be coming and making big purchasing decisions around that. So I think it will be important for some of this uncertainty to settle down over time if we're going to see the strong, robust economic growth that we all want to.
Is that uncertainty going to settle down anytime soon, in your view?
Well, it depends on what the administration's policy is. We've seen tariff rates go up and then they come back down, and then tariffs get put back on, and then they taken off. And that is really challenging for fostering growth in the economy. It'll really be up to the administration and the negotiations that they are undertaking right now with many countries across the world, and we'll have to see what those tariff rates end up at. We are right now at 10% across the board and higher on China, Canada, and Mexico, and then there are these potential additions that you just mentioned at the top. If those all go up, then I think we're in for a difficult second half of the year for the economy. If we settle into a more natural state of equilibrium, even if that includes some tariffs, I think people will feel more confident about planning for the future.
I thought the tariffs were supposed to offer the tax cut.
So this is another challenge, which is that we've heard competing visions and goals for what the purposes of these tariffs are. The president has said that he wants to bring in a massive amount of revenue from the tariffs. We've seen a little bit of revenue come in. We have a tracker that shows that tariffs are coming in at higher rates than they were in previous years, but nothing that's going to materially change our fiscal challenge. And that is at odds with the purpose of the tariffs to incentivize renegotiations of the trading relationships that will result in more free trade. Because, of course, if we get freer trade and tariff rates come back down, they're not going to bring in that revenue that's being discussed. So we'll have to see where those two competing priorities leave us. But I think the bottom line for the fiscal situation, which is getting quite dire in this country, is it's unlikely that tariffs are going to play a major role in getting us out of the situation that we've gotten ourselves into.
Talk about Europe then, because I'm curious what this tariff rate on the EU that the president proposed this morning does to the U.S. economy, to the U.S. consumer, if it were to stay in the place the president is proposing it at the moment.
Well, rates that are along the lines of 50% or 145% or things like that, those are just unsustainable for the type of business relationships that we have with many of these countries, or for the relationships that our businesses rely on. We've really never experienced policy like that, so it's even difficult to predict exactly what that will mean for the economy. But domestically, consumers right now are really going through a period where we've been through a bout of high inflation. Many families are still struggling to make ends meet, and it's very unclear what this is going to look like for the second half of the year. That's true for businesses as well. What's making things worse is that we have an unsustainable fiscal situation that is leading to very challenging dynamics in the bond markets, where we're having to pay higher interest rates to service our debts. Yeah. And that ultimately is leading to higher interest rates across the economy and feeding the inflation that we've seen in past years and that we might continue to see from the tariff dynamic that's going on. So all of these factors are really causing a lot of economic uncertainty and strife.
Another piece of economic uncertainty that's unfolding in terms of the policy right now is on immigration. We have the president calling for international students at Harvard to transfer. I'm curious from your perspective about how big a risk you think the president's immigration policy could be to the economy longer term.
So immigration is a key factor in our economic growth. We, of course, have been the place that is most desirable for immigrants to go in the world, and we rely on their talents to accelerate our economic growth, to create innovation in our economy, and that ultimately benefits all Americans. What's important in immigration policy is to make sure that we don't cut that off. There are certainly a variety of goals. We need to make sure that, of course, we have secure borders and people are getting into this country in a fashion that is legal. But at the same time, if we choke off that immigration funnel, it's going to ultimately mean fewer people who are contributing to the American economy, slower economic growth, and that's not what any American should want. So we need to find a balance on policy that can achieve both of those goals simultaneously. We'll have to see where this ultimately ends up between the enforcement side and the immigration policy side of how we make sure that there's a pipeline of immigrants coming to the country. But it is a really critical factor both for our workforce and for the research and innovation that goes on in our economy.
Shai, thank you so much. Appreciate it. Coming up here on the Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, we speak to one stock picker to see if Nvidia is a buy ahead of its earnings, and Apple taking a hit as President Trump threatens the company with tariffs if they don't produce in the United States. All that and more coming up on Morning Brief.
It's now time for some of today's trending tickers. We are watching Stellantis, Apple, and Intuit. First up, shares of Stellantis falling after President Trump calls for a 50% tariff on the European Union. The automaker behind both European and American car brands, including Chrysler, Dodge, Fiat, Maserati, falling on the news by about 5% here. The president saying he wants to see the EU tariffs go into effect as soon as June 1st. In a post on Truth Social, his exact words, I believe, saying that the European Union, which was formed for the primary purpose of taking advantage of the United States on trade, has been very difficult to deal with. Our discussions with them are going nowhere. There you see the post on your screen, and we will see ultimately if these calls for a tariff, additional tariff, do go into effect here.
Yeah, and of course this comes after Stellantis earlier this month reporting first quarter sales falling 14% here compared with the same period of the year prior. And they did say they would not make any predictions about profits for the year to come, given the concerns about tariffs. I should also note the company does report profits every 6 months rather than quarterly, but still, they are the latest automaker to say we don't want to forecast to investors where things are heading, given the uncertainty with regard to tariff policy. I think an uncertainty that investors had started to somewhat get complacent about when we saw markets kind of continuing to grind higher, even though we did not have any deals with any countries that the United States put increased tariffs on. And now we have yet another tariff potentially slapped on the EU.
You know, one other facet of this, and I know we're taking a look at Stellantis. I don't know if we can pull up Tesla shares real quick here, because pre-market that was moving lower. Tesla also has a little bit of an exposure to this. Of course, they have Gigafactory Berlin, but there are still parts that actually get shipped into that factory in order to make sure that they can then manufacture and produce a finished vehicle to then ship out either to people that are within the EU, customers within the EU, or elsewhere. And so that is something that if we continue to see even more of a ratcheting higher of some of the tariff rates between the US and the EU, could also have an outsized or overarching impact on Tesla as well here. You're seeing shares pre-market, at least right now, down by about 1.25%.
Yeah, pain for all the automakers. But next, President Trump saying on social media, 25% or higher tariff must be paid by Apple on all internationally produced iPhones. The announcement sending shares of Apple lower. While Apple's iPhones are primarily produced in China, the company has shifted more production to India amid trade tensions. Wedbush's Dan Ives this morning reiterating his call that a U.S.-produced iPhone could cost as much as $3,500, something that he and several other sources that I have spoken with say would be bearish for Apple going forward, especially given concerns about the upgrading cycle. How long will consumers try to hold on to their iPhones if, in fact, we do see prices going up to account for any move of production to the U.S.? Obviously, also, that would take a long amount of time to be able to do that. Dan Ives in his initial note noted that a small percentage of Apple's production being moved to the U.S. would take a decade, so this isn't something that can happen overnight.
Look, a $3,500 iPhone, there's nothing about that is pro-consumer, so there's nothing about that is actually pro-economy, especially if it's going to take however many years to even bring some of those jobs. In the hypothetical scenario that Apple actually wanted to do this, that would bring those jobs onto U.S. soil, number one. Number two, there's nothing about a $3,500 iPhone or interfering with a company's operations because you don't agree about where they're being produced, regardless of where you are trying to draw some of these larger trade deals to come forward, that is actually pro-business either, because it makes it more hard to forecast for all of these companies that are trying to figure out, okay, how can they still provide a product into a region that makes up 50%, roughly 50% of their overall revenue base. There's nothing about that is pro-business, especially if you are just saying, hey, I disagree with how you're operating, so I'm going to target you specifically and target the product that I know is going to hurt you the most here. And so this is just a continuation of what we've seen in how the president goes after certain companies who do not align with what he's trying to get out of either trade deals or ideological structures that he's trying to push forward. Also, shares of Intuit moving higher after the company issued stronger than expected results for its third quarter and raised its full year guidance. Intuit crediting its investments in AI products and services for its strong tax preparation quarter performance. The Trump administration's cuts to the IRS could also bring more customers to Intuit products. Stay tuned for Catalyst. We're going to be speaking to the Intuit CFO here. Quick comment as you're seeing shares move higher by about 7.5%, I think it was on the screen when I saw it a moment ago here. They're saying that they have exceptional momentum, outstanding performance across their platform, and also leveraging even more AI agents and AI-enabled human experts as part of the overall product that their service that they're putting forward.
Yeah, the CEO talking about how they have AI-enabled human experts on staff to fuel the success of consumers and, of course, small and mid-market businesses. This is a great company to talk to get a sense of how those smaller and medium-sized businesses across the country are doing. So that's something we'll be speaking with the CFO about later on. Revenue for the year estimated to grow at 15%. Prior guidance was 12% growth. So they're continuing to move forward with that growth story amid macro uncertainty. Well, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. Retail woes hitting Deckers and Ross stores. Deckers issuing a weaker than expected outlook for the current quarter and declining to share an outlook for fiscal 2026, citing macroeconomic uncertainties. Similar story unfolding for Ross, withdrawing its full-year outlook due to the expected impact of tariffs. Joining us now, Sucharita Kadali, Forrester Research retail analyst. Sucharita, great to speak with you. I know that you see off-price retailers being able to hold up in this environment. Why?
Well, when you have any type of uncertainty or concerns about the economy, there is always a flight to value. So certainly the areas that you're going to see people going to are the warehouse clubs. You'll see them going to off-price like TJX and Ross, and you'll see them going to some of the value mass merchants. And that's why we continue to see companies like Walmart and even Amazon thriving in this environment.
And so for consumers who are looking for any type of easing of their overall needed spends right now, and then versus the discretionary spends where we're clearly seeing some pressure there, how are you kind of navigating that discretionary dollar flow right now and tracking that, Sucharita?
Well, it's a lot like what we saw during the pandemic, where you did see the success and the growth in the essentials category. So we expect anyone who is a value merchant in that category, whether it is the mass merchants, the club channel, to do particularly well and to pick up share, because as people are cutting back, what are they in fact going to be spending on? They're going to be spending on, of course, essential goods. That's grocery. It'll be over-the-counter items. It'll be the things that they absolutely need. Discretionary, even for discretionary, you are still going to see that flight to value, and that is where off-price ultimately has a benefit. The numbers for Ross and Deckers today weren't terrible. They were actually much stronger, I would say, than what maybe the kind of, I think, conventional wisdom may have suggested. The issue was really their outlook and the fact that the earnings were lagging indicators. These are just numbers through March, and we still haven't seen the shoe drop with full respect to the tariffs. And we don't know when that's going to be. It's probably going to be this summer. It may not be ever if there are negotiations and deals cut.
And talk to me, Sucharita, about what that means for consumers here, especially as we head into Memorial Day weekend. Is this the last sale weekend that we're going to have, given inventory concerns going forward?
Well, that is a good question. Potentially so. If you really dug into, for instance, the Deckers, some of the commentary in their press releases, their wholesale numbers were actually the strongest, which suggests that there are a lot of retailers that in worries and anticipation of tariffs were front-loading inventory. So if that inventory of Hokas and Uggs are in stores now, the retailer is going to do one of two things. They're either going to hoard that merchandise, or they're just going to try to unload it at a sale discount. But I suspect that it's probably more about hoarding for now. It may be later in the summer before we see the sales, and that's going to be part and parcel dependent on any deals that the U.S. is able to cut with other trading partners.
So if you had to grade the retail environment right now, who's getting a A, who's just barely passing, and who's failing?
Well, it's a lot of the same story, Brad, that we have seen for a few years now. You still have the rise of the biggest titans continuing to grow. That's Amazon, that is Walmart. That's Costco. Those are the players that continue to gain share in this hyper-competitive environment. You also have some much, much smaller merchants. There is an e-commerce platform called Shopify that actually powers a lot of the teeny tiny merchants that are out there. And they're using the internet and TikTok and other resources to gain awareness and also grow shares. So it's a lot of the retailers in the middle, a lot of our traditional mall merchants that are some of the most challenged.
Sucharita, great to see you. Thanks so much for taking the time with us this morning.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching the Morning Brief. Today you're taking a look at this Friday opening bell ahead of the holiday weekend. The New York Stock Exchange, you've got a good look at Fleet Week, New York 2025, ringing the opening bell there. And Renatus Tactical Acquisition Corp ringing the opening bell at the NASDAQ in Midtown Manhattan. All right, let's take a look at how we begin things here on the day. I'm just going to tab us on over to our major averages here, as we've got the Dow Jones Industrial Average right now beginning the day with some slippage. Right now, we're down by about 1.1%. Year to date, you're taking a look at the Dow as well here with our chart. Let's put this on a line chart for you, if we may, just so you can get a better view and off of some of those candlesticks. Okay, year to date, we're back in negative territory this week, and taking a look at that, we're down by about 2.7% now year to date. NASDAQ Composite now seeing some slippage year to date as well. We're down by about 3.5% there, 1.7% lower here on the day's session. And the S&P 500, you're seeing that down by about 1.2% right now. As we're taking a look at some of the sector activity, 11 S&P 500 sectors, we've got them pulled up on the screen for you here. We're mixed, however, clearly more laggards than gainers, unfortunately, right now, as we've got utilities that is leading the pack. That's up by about 0.8%, but bringing up the caboose, consumer discretionary. We were just talking about some of those retail names catching a little bit of pressure because of the outlooks here, weaker than expected across Ross and Deckers that were in focus that we were tracking and discussing a moment ago here. And take a look at consumer discretionary sector, that's down by about 1.6, 1.7%. You've also got, and I was trying to pull up this other, yep, there we go. Technology, 1.6% in decline. Speaking of technology, here's a look at the NASDAQ 100. You've got only a few peppered in spots of green, and that is coming in the form of Intuit. We were just talking about some of their earnings here. We've got a discussion with their CFO coming up, but shares of Intuit starting off the day on a positive note. They're up by about 8%. We'll round that off too. However, those mega cap tech stocks, some of the Magnificent Seven, all of the Magnificent Seven actually, we're looking like we're in the red across the board there. Nvidia down by about 2.4%. Apple lower by about 2.7% here, as they're catching some pressure, and potentially, if you do see additional tariffs go into effect on iPhones, then that could have a major impact on shares of Apple, or at least the thesis around it, especially one of the largest product divisions for the company, the largest essentially. So we're taking a look at shares there, down by about 2.8%. And then just lastly here, I do want to ride out with a look at the Dow components, the Dow 30, if you will, as again, just a few spots of green that are peppered in here. United Healthcare, oh my gosh, sigh of relief that they're higher. That's up by about 0.9%. But yeah, I heard you like some broader context here, so let's contextualize this. Trailing 17 sessions, down by about 27%. And then some of the same laggards here, Apple, Nvidia, and then Disney as well. That's also moving lower by about 1.8%. Maddie, I'll toss it back on over to you at the desk.
All right, thanks, Brad. It's time now for today's strategy session, watching Nvidia ahead of earnings on Wednesday. Take a look at this chart. It shows the median return on the stock, depending on how long you hold it before the earnings report. Buying the stock just 1 day prior has a median return of 2.3%. Joining us now on this, Nancy Tangler, Laffer Tangler Investments CEO and CIO. Nancy, always great to chat. How are you thinking about Nvidia ahead of its earnings report? Have you changed any of your positioning at all?
Well, Madison, thanks so much for having me, and happy Memorial Day weekend. We added to the stock during the tariff turmoil, and so we picked it off at a pretty nice level, dollar cost averaged our positions in. But I still think you want to own this stock for the very long term. This is a company that's central to the AI revolution, obviously. And what we've learned from the deep fake, as I call it, is that The hyperscalers in the U.S. companies are doubling down on CapEx, and they are still investing at a really rapid clip. And so this is a name that I think you want to own and take advantage of if they do disappoint on margins and the market isn't expecting that, which is what we expect.
What do you need to hear from Nvidia to clearly signal that the demand profile that they've continued to express to the street in quarters past is still there, and not just still there, but has even more room for growth, even with some of the international implications that investors have had to factor in?
Yeah, so Brad, I mean, I think that Jensen Huang announcing that they're opening up their platform is a head nod to the capacity constraint that we're hearing about from Microsoft and Amazon, and that is we could have grown faster, but for the fact that we couldn't get chips, and there's an infrastructure issue. So I think what I'd like to hear is that the company continues to innovate and they continue to adapt to the constraints, I'll say, that we're getting out of the administration. So we expect in the second half, you will see the newly redesigned China chip adding to growth. And so I expect to hear a little bit about that. And then because input costs are up, I'd like to hear something about, okay, if margins are in fact down, are they compressing overall, or is this a short-term blip?
Nancy, I want to switch gears a little bit because we have Apple shedding more than $100 billion in market cap at the market open today after the president threatened a 25% tariff on Apple if it doesn't make iPhones in the United States. Apple is obviously down year to date at the moment. How are you thinking about Apple? Is it still investable?
I do believe it is, Madison. I mean, it was our largest holding for many years, and then as it continued to depreciate, we sold it down. And so we have what we would consider a minimum position of about 2%. And that's largely because I think we're waiting to see what's important to us is what they're going to do with AI. And so we think there's better places to be adding to at this particular point. But I will say this, I think this is silliness. I mean, this is what we call industrial policy, but usually industrial policy comes with incentives. And so, governing the private sector via Truth Social feels really uncomfortable to me. And I think if the shoe were on the other foot and someone told President Trump he couldn't build golf courses in Scotland, I think he would have a very different view of the situation. It is ridiculous to think that Apple can move all of their manufacturing back to the United States. It's also ridiculous to think that consumers are willing to pay the $3,000 to $5,000 estimates for an iPhone if they are built in the United States. Stepping
on golf shoes with that one, Nancy, here. As you know, we're thinking about this broader market, and we've moved off of some of the levels where 80% of the market was trading below its 200-day moving average. We're now back to, and we have been in kind of a 50-50 or at least 60-40 territory here for a week and change now. So at this juncture, what areas of the market are perhaps best positioned to even outperform the Mag 7 as you're kind of looking at where we're going to see this market be led by for the remainder of the year, the balance, even as we're waiting for the negotiation to net out for some of these trade deals?
Yeah, that's a great question, Brad. I would say what we did during March, April, was we added some new names that we thought were somewhat impervious to tariffs. So on your previous segment, you were talking about the retailers. We added to a position in TJ Maxx, which we should have already owned, but best managed retailer, I think, discount retailer, buying inventories that are already here. That's important. But we also added a name like Accenture, which had a very difficult period. We picked it off at lower levels, which is what you want to do. And we think they're going to be in the sweet spot of adapting old economy companies to AI. And then you want to own the software companies because they too have very modest exposure to tariffs. So think CrowdStrike, Palantir, Microsoft, ServiceNow, which has beat and raised over the last couple of quarters. I think that Snowflake, that's where you want to be exposed in the next round of the AI revolution, and that's important because if we are in a decelerating economy, you want to own the reliable growers. And these companies have demonstrated in 2022, 2023, 2024 that they can deliver reliable earnings growth.
Nancy, final minute. When you think about the Mag 7, the basket of those magnificent 7 stocks, how are you thinking about how Apple impacts that basket? And especially for our audience of retail investors, can they rest on their laurels of investing in Mag 7 ETFs if Apple's still in there?
I do think so, Madison. I mean, usually what happens, we run a 12-stock portfolio, and what happens is you've got one stock that doesn't do anything for a year, and then it carries the day the following year. So I think Apple's done the heavy lifting for quite some time in the Mag 7. Maybe they can hand it off to, Amazon, which we love at these levels, and apparently so does Bill Ackman, and also, or Tesla, which has come back, from the ashes. So I think you can be comfortable there, because this is not the 1990s internet company. These are companies with robust balance sheets, lots of levels to pull. Microsoft demonstrated that in the last quarter. Nvidia is opening up partnerships with all of these companies. So I think you can still own those names for some time to come.
Nancy, good to see you. Thanks so much for taking the time here with us.
Thanks for having me.
Let's get to the 3 market movers that you need to watch for the trading day. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Thank you. I am watching some mixed signals in stocks. Tech stocks look a lot healthier than some of the other majors, and we're going to get into that. But I'm also watching U.S. rates cool. That has been a yellow to orange warning flag all week long, and we're going to dig into that. And then physical gold, guess what? That is surging while Bitcoin is backing off all-time highs. So let's dig in here to the Wi-Fi Interactive. I'm going to check out the iShares MSCI ACWI, that's All Country World Index, because that was hitting a record high earlier this week. So the whole world, as you put all the stocks together and average them, they have hit a record high this week, but you can see we have backed off considerably from that. So that index is down about 1.85% this week. Now let's take a look at the Dow. This is over 5 days, basically 2 3/4%. NASDAQ 100 to just a little bit under that, 2 2/3%, and the S&P 500 down a little bit more, almost 3%. But I want to show you the year-to-date, and I think it's fitting. We're coming on Memorial Day holiday, and a lot of the charts that I'm watching are forming bullish flags. And here's the S&P 500. We have this nice up rally, then we have a little bit of a dip here, but it's looking like a flag. And you can see this better if you squint. You can put on some candlesticks, and you can see it right there. And in fact, we're seeing this in other markets. But first, I want to show you what's going on with the VIX. And this is a year-to-date look as well. The VIX is surging the most, and this is almost 5 points in about 6 weeks. So this is another yellow warning flag that we have to pay attention to, because we've seen the VIX explode with momentum to the upside. So we don't want this little bit of a downdraft to continue on throughout the day into the close, and especially next week. But now I want to shift to what's happening in the tech sector. This is a year-to-date of Nvidia, and this is actually a nicer looking flag than we're seeing here. This is about 8 price action days worth, and we can see Nvidia looks like it's consolidating for a move. And then the Mag 7 overall, this is a MAGS ETF, MAGS, very similar to Nvidia. So you put it all together in the stock world, we got a little bit of a sell-off here, but the potential for another up leg, but that would take another catalyst, and probably not going to see one this week. Now here's rates. 30-year T-bond yield, we came down from yesterday's highs. We are now at 5.02%, so still holding that psychological 5% level. When we surged above it earlier this week, that caused stocks to roll over. Maybe not caused, but at least it was correlated with. So this is one of the big picture themes I'm thinking of, and we have some big auctions on deck next week. I believe it's the 2s, 5s, and 7s, don't quote me on that, but 3 big auctions next week. And so all the traders are going to be focused heavily on that. Also watching the US dollar index, that cooled off slightly, so that was down to maybe a 2 or 3 week low. Nothing to write home about, but dollar weakness has been one of my themes as well, because the whole world earlier, a month ago, was anything but dollars. So we don't want that theme to redevelop here. Finally, let's get into the metals, and physical gold is surging here, having one of the best weeks in a long time. This is a year-to-date chart, and I'll put some lines on there so you can see it a little bit better. But basically, we have just now broken out of its own flag formation, and we have record highs in sight there, somewhere around 3,500. We're at 33.47 right now, and we're up 1.6%. On the week, we are up 3.68%, and I think that's the best in about 6 weeks. Silver futures looking kind of sideways right here. They've gone sideways over the last month, but pressing up against some of those prior resistance points. Need to see a breakout there to get some continuation. But I want to move on to Bitcoin, because Bitcoin has kind of stolen the show this week. We broke out of the 108,000 all-time highs from January only a few days ago. And now, today, we came back down to 108,000. Let me show you the two-day view. Came back down to 108,000. That was a prior resistance level, and now we are higher. And so that's a perfectly normal thing to do when any security, any taker breaks out, you see it come back down to that prior breakout level. As long as that holds, I would expect higher highs in the coming days. So you put it all together, kind of a mixed picture with respect to risk markets, and I'm going to be watching those rates markets like a hawk, especially next week when we have those auctions. Guys?
Jared, thank you so much, as always. Coming up here, nuclear stocks on the rise this morning as President Trump is expected to issue executive orders to help the industry. We're discussing with the CEO of Nano Nuclear Energy. That'll be next at Brown. Nuclear stocks rising on expectations that President Trump will sign several executive orders easing regulations and boosting productivity for the sector. According to Reuters, the executive orders would use the Defense Production Act to declare a national emergency, making it easier to permit and build reactors, and order federal agencies to identify publicly owned lands that could be used for nuclear production. Joining us now with more, we've got JU Nano Nuclear Energy founder, executive chairman, and president. Thank you so much for coming in.
Thanks for having me today.
Talk to me about your reaction to these proposed executive orders. What do you make of the policy shift, and what does it do for your company?
I mean, we kind of expected this because of the Secretary of Energy, Chris Wright. He's been going around promoting and saying that under this administration, there will be a nuclear renaissance. And this has been a full circle for us, because we started the company about 4 years ago and went all in on nuclear. And we kind of predicted, I would say, or I predicted this type of shift, because everyone keeps talking about net zero goals. Like, how are you going to reach that? How are all these countries going to reach that without nuclear? So that was kind of our thesis, and we're very happy with what the administration is doing right now.
Some of this, too, was really signaled by companies, even towards the end of last year, as we were hearing about some of their data center ambitions and making sure that they had access to their own energy, and companies like Oracle talking about looking at land for nuclear reactors. So what's really going to be driving this? Is it the private sector that's putting and earmarking and has been earmarking billions of dollars, or is it the public sector and some of the commitments there that we're starting to hear more about?
Yeah, I think the advancement of technologies, new nuclear technologies like what Nano is building, a lot of these new reactors, their technologies, they can't explode. They use no liquid coolant, right? So I think the technologies have now advanced that the market understands this, but now it's basically the costs and the regulatory aspect. And this is what the executive orders really touch on. It's the regulatory burdens, right? And how we could expedite this. And AI and quantum computing and data centers now are on the rise, and they understand that without nuclear, it's going to be a really hard issue to actually get to this base load energy production.
Earlier this week, we saw your stock and, of course, several other stocks in the space down off the back of what's included in the tax bill and concerns about the rollback of IRA funding specifically. Why do these executive orders this morning make investors so much more bullish about the stock, even though that IRA rollback is still happening? Yeah, great question. I think mainly because easing of the regulatory burden. The Nuclear Regulatory Commission has been kind of like an eyesore in this process, and now with this executive order, it can help ease that, but also potentially funding opportunities, because I think that's been the goal here. When you think of nuclear, you think of big costs, but with small nuclear, what Nano Nuclear is developing, the costs come down drastically. So if we could get help from the government, easing with regulatory burden, and also we've hired
in-house a lot of these regulatory people who are guiding us to the future.
With that in mind, I mean, I guess I put the conscious capital hat on for this one. Are we thinking about nuclear in the future as something that is not only positive for the productivity side of the equation, but also positive on a net emission side? Like how do we balance those things against what companies have said in the past against their own ambitious goals for any type of environmental and social governance?
Yeah, I think when you look at nuclear energy, I think the perception, like the PR, we've used this from inception for bad things, right? But really, it's a miracle that was given to us. It pretty much creates the most baseload energy in a small fraction of an area, and that could drive us for decades, right? So I think people are realizing that it's virtually carbon-free emission, so that helps with the decarbonization of the world and the net zero goals. And I think this is where the private sector and public sector have to unite in order to actually succeed. But back to your point, it's all about clean tech, green energy for the future, and reducing carbon emissions for the Earth.
Jay, thanks so much for taking the time
joining
us here in studio on a Friday, no less. We didn't expect to see anybody in studio. Thanks so much. Appreciate it.
Thank you so much.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief. A Supreme Court ruling may pave the way for greater protection of Fed officials against being fired by a U.S. president. Yahoo Finance Fed correspondent Jennifer Schonberger has the story for us. Jennifer, what do we need to know?
Good morning, Brad. The Supreme Court moved late Thursday to essentially insulate members of the Federal Reserve Board, including Fed Chair Jay Powell, from being fired by the president. The High Court protecting the Fed even as it let firings of board members stand at the National Labor Relations Board and the Merit Systems Protection Board, while those legal challenges to those removals make their way through the legal system. The justices said that we disagree with arguments made by the National Labor Relations Board and the Merit Systems Protection Board that their legal challenges necessarily implicate the constitutionality of for-cause removal protections for members of the Federal Reserve's Board of Governors or other members of the Federal Open Market Committee. The central bank, the court added, is, quote, uniquely structured quasi-private entity that follows in the distinct historical tradition of the first and second banks of the United States. Now, the only language in the law pertaining specifically to the removal of Fed board members can be found in Section 10 of the Federal Reserve Act. That law states that each member of the board shall hold office for 14 years unless sooner removed for cause by the president. The statute doesn't specifically address the Fed chair, nor does it detail what exactly constitutes, quote, for cause. That term has been interpreted in legal rulings to mean inefficiency or neglect of duty or malfeasance. Of course, President Trump posted on social media earlier this year that Fed Chair Jay Powell's, quote, termination cannot come soon enough, before clarifying that he has no intention of removing the Fed chair before his term concludes in May 2026. And guys, separately this morning, Chicago Fed President Austin Goolsbee told CNBC that he is gratified that the Supreme Court of the United States has acknowledged the importance of central bank independence. Back to you.
Thank you, Jennifer. Coming up here, it's going to do it for Morning Brief. You can join me in the next hour for more analysis on catalysts and then Brad for Wealth after. Stick around.